No protests, no headlines, no votes in Congress. Just a group of men in suits meeting quietly in a Swiss city called Basel. It sounds absurd, but those closed-door meetings created the most powerful financial laws on earth. These rules dictate how much cash your bank can lend, how much risk it can carry, and how much real money it needs to keep in reserve. They are the blueprint for a global safety, and most Americans have never heard of them. This whole mess started back in 1974 with a small German bank called Herstatt. Herstatt was a mid-sized institution that specialized in foreign exchange. One afternoon in June, it went totally bankrupt right in the middle of a currency transaction. American counterparties had sent millions of dollars to Germany that morning, but when the German side was supposed to send the equivalent money back that afternoon, Herstatt was gone. That timing, stuck between time zones, froze the entire global payment network. It was a rude awakening. Banks around the world suddenly realized how fragile the system was. Globalization had connected every major financial center, but the rules were still local. The panic forced the world's central bankers, the G10 economies, to coordinate. They gathered in Switzerland at the Bank for International Settlements, which is like the central bank for central banks. In that quiet environment, they formed the Basel Committee on Banking Supervision. Their mission? Make sure a major bank never collapses again due to messed up rules. It took over a decade, but in 1988, they unveiled Basel I. This was the first truly international banking standard. The rule was simple. Banks had to keep at least 8% of their risky lending as capital. In plain English, if a bank loans out $100, it must keep $8 of its own money ready as a safety cushion. This became the global yardstick overnight. Basel I was not technically a law, but it became a law in practice. If you were a bank not playing by Basel's rules, no one wanted to play with you. But the simplicity of Basel I contained a massive flaw. To apply that 8% rule, regulators had to categorize assets by risk. They decided government debt had a 0% risk weight. Banks didn't need to hold any capital against it. Corporate loans, on the other hand, required the full buffer. The effect was dramatic. Banks began pouring money into government bonds instead of lending money to businesses. Lending to the private sector suddenly looked too expensive. A rule meant to make banking safer quietly redirected global credit toward the state. By the late 1990s, the world had changed. Financial markets had exploded. Derivatives and complex global flows made Basel I look primitive. Banks complained they could measure risk better than regulators could. In 2004, Basel II arrived as the modernized system. It sounded responsible, minimum capital rules, supervisory review, and market discipline. But in reality, it handed the keys to the vault back to the bankers. Under Basel II, large institutions could use their own secret math, their internal formulas, to decide how much capital they needed. If their spreadsheet said an asset was safe, they could set aside less money and lend more. The incentive was obvious. The lower your calculated risk, the higher your profit. Banks got creative. They began assigning extremely low risk weights to assets like AAA-rated mortgage bonds right before 2008. Their models treated these assets as safe as government debt. We now know they were toxic time bombs, but the rules allowed them to multiply these assets across their balance sheets at breathtaking leverage. Then came the crash. The subprime crisis revealed that the entire risk-weighting system was built on sand. The models used the wrong math, and the safest assets turned out to be the most dangerous. Trillions evaporated. Governments rushed to back-fix it with Basel III, starting around 2010. This version promised to fix everything. Regulators insisted that only true equity and retained earnings counted as real safety buffers. They introduced new ratios, like the leverage ratio, which is a simple backstop against excessive borrowing, and the liquidity coverage ratio, which forces banks to hold enough high-quality assets to survive a 30-day market freeze. In theory, Basel III made the system tougher. But here is the terrifying part. The complexity exploded. What started as a simple 8% rule evolved into a labyrinth of cross-reference calculations. Even after all the reforms, many major banks still operate at dangerous leverage. For every $100 a bank has in assets, some still hold less than $5 in true capital. The language of Basel became so technical that only insiders could follow it. Risk didn't disappear, it just changed its shape and became invisible. Regulators knew banks had learned to manipulate those internal models to minimize their cash buffers. So now we have Basel IV, the final attempt to close the loopholes. Basel IV introduced the output floor, a critical safety net. No matter how fancy a bank's math is, it cannot reduce its capital requirements by more than roughly 27% compared to the standardized rules. It puts a limit on their creativity. The global rollout started in 2023 and will stretch into the late 2020s. These silent rules are now the invisible architecture of global finance. They decide whose economies grow faster and who gets credit. When Basel declared government bonds risk-free, it created a constant structural demand for public debt. Banks shifted massive portions of their money into state debt, creating a built-in buyer for governments. The rules reward the state and punish the small business. For smaller regional banks, compliance with Basel III and IV requires vast resources, expensive data systems, modeling teams, and constant audits. That's easy for giant banks. It is ruinous for smaller lenders. Basel, meant to prevent systemic risk, quietly sped up the concentration of power into the hands of the too-big-to-fail banks. The danger is also uniformity. Every major bank on the planet now measures risk the same way. When everyone holds the same assets and reacts to the same triggers, the system becomes synchronized and brittle. One domino falls and the rest follow. Here's the ultimate twist. Basel is not technically a law. It has no police force and no legal power. But if your bank or your country doesn't meet these standards, international lenders will punish you. Your credit ratings fall and borrowing becomes expensive. It is not law, it is leverage. If your country lags behind, its financial institutions risk isolation from the global network that moves dollars across borders. Giant banks bound by Basel cannot afford to work with partners from non-equivalent places. This silent exclusion means countries that lag lose access to cheap credit and the lifeblood of modern commerce. What do we learn? Regulation can never fully control risk. It can only redirect it. Each attempt to make banking safer pushes the danger somewhere else, into a new loophole or a less regulated part of the world. Basel did not eliminate the boom-bust cycle. It simply changed its geography. In the end, Basel made banking invisible, and whoever writes the rules for invisible risk rules the world. If this gave you a new perspective, hit the like button. Make sure you subscribe and click that notification bell. Thanks for watching.